Most people think they lose money in the stock market because they picked the wrong stock. That is a comforting story. It protects the ego. It lets you believe the real problem was just one bad ticker, one mistimed trade, one unlucky week. I do not believe that. Most people lose money because they outsource their judgment, rent their conviction from strangers, and then act surprised when fear evicts them at the worst possible moment. That is the real diagnosis. By the time a stock becomes exciting enough to appear in your feed, your friend group, the financial press, and the mouths of people who never cared about businesses until last Tuesday, the easy part of the move is usually already behind you. News is not an early warning system for opportunity. News is often a delayed explanation for a price move that has already happened. And if you buy a business only after the spotlight finds it, there is a good chance you are not buying value. You are buying applause. Applause is expensive. Applause is unstable. Applause leaves the room the second the music changes. I have watched generations of investors confuse motion with truth. A stock rises, so they say the company must be strong. A stock falls, so they say something must be wrong. That is backwards. Price is not the business. Price is the negotiation around the business. It is the crowd S mood, the market S weather, the temporary vote of people whose time horizon may be 3 hours, 3 weeks, or 3 months. I do not build fortunes on moods. I build them on engines. That is the first identity shift most investors never make. They remain spectators of price. They never become underwriters of business reality. If you want the market to stop humiliating you, you have to stop approaching it like a viewer and start approaching it like an owner. When I look at a stock, I am not asking whether the chart looks friendly. I am asking a much harsher question. If the stock market closed for 10 years after I bought this business, would I still be glad to own it? Most people never ask that question because they do not really want an answer. They want reassurance. They want a story they can repeat to themselves until the price goes up and validates them. That is not investing. That is emotional borrowing, and borrowed conviction has a very high interest rate. Let me give you the operating system I trust instead. Not a tip, not a hot list, not a motivational speech, an operating system, because that is what most people are missing. They think investing fails because they need better predictions. Number investing fails because they have no internal protocol for deciding what deserves their money, what deserves their patience, and what deserves to be rejected. No matter how exciting it looks on a screen, my protocol begins with a brutal rule. Do not ask what the stock is doing. Ask what the business is doing. That sounds simple. It is simple. But simplicity is not a thing as ease. A great many people are perfectly willing to spend 3 hours listening to market gossip and almost no time trying to understand how a company actually earns $1. Then they call the market irrational. The market is not punishing them for lack of brilliance. It is punishing them for lack of seriousness. I want to show you the machinery underneath this. I call the first mechanism the headline delay. You see a stock in the news. You see a video explaining why it is the next winner. You hear a friend say institutions are buying it. That feels like information. Most of the time, it is evidence that the move has already attracted enough attention to become public entertainment. A stock usually does not become famous before it rises. It becomes famous because it rose. The sequence matters. If a business improves quietly, the stock may begin moving before the crowd even knows what changed. Then the movement itself creates curiosity. Then analysts write about it. Then journalists explain it. Then social media turns it into a parade. Then retail investors arrive and call themselves early. They are not early. They are emotionally synchronized with visibility. Visibility is not value. Visibility is often the toll booth you pay after others have already crossed the bridge. That is why I've always preferred discomfort to popularity. In 2008, when fear was tearing through financial markets and institutions were being treated like collapsing buildings, I did not ask whether the headlines felt safe. I asked whether selected businesses still had earning power, franchise value, financing options, and terms favorable enough to justify action. That is how I entered Goldman Sachs through a rescue-style structure with preferred shares and warrants, while much of the world wanted nothing to do with financial assets. To the crowd, it looked insane. To me, it was simply a question of price structure and survival odds. The crowd was staring at flames. I was studying the fireproofing that leads to the second mechanism. I call it the price hallucination. Most investors believe the stock market is a truth machine. It is not. It is an exaggeration machine. When people are greedy, it overpraises. When people are afraid, it overpunishes. If you are trained only by price, then rising prices make you feel safer, even when risk is increasing, and falling prices make you feel endangered, even when value is improving. That is how investors become their own worst execution problem. They buy when the emotional environment feels easiest. They sell when the emotional environment feels hardest. Then they wonder why their results lag the very assets they claim to own for the long run. The answer is humiliatingly simple. They did not truly own them. They rented them until volatility sent the bill. I have no interest in renting businesses. I want to buy them. To do that, I need to know whether the business can turn capital into earnings with unusual consistency. This is the third mechanism. I call it the quality engine. Now, people like to make this sound mysterious. It is not mysterious. If I hand a manager $1, I want to know how much honest earning power that dollar can produce. If a business repeatedly uses its equity base to produce high returns, that tells me something important. It tells me there may be a moat somewhere in the structure, a habit of customer loyalty, a network effect, a cost advantage, a brand, an ecosystem, a distribution advantage, an irreplaceable location in the economic chain. If I owned a simple little fried chicken stand with $1 million of my own money and it earned me $150,000 after a year, I would understand the math immediately. That capital produced 15% fine. Now suppose a competitor opens next door and my profits collapse. Then what I had was not really a moat. It was an empty parking lot around a weak business. But suppose my profits hold up because customers keep coming, the location is impossible to replicate, and the economics remain attractive even with pressure nearby. Now we are seeing something stronger. A business that resists imitation deserves far more respect than a business that merely enjoys a lucky season. This is why I have always cared less about excitement and more about resilience. The best businesses are not the ones that look glamorous at the top of the cycle. They are the ones that keep making good money when life is inconvenient. Coca-Cola did not fascinate me because it was fashionable. It fascinated me because the product, the brand, the habit, and the distribution system formed a durable earning machine. People drink it in prosperity, they drink it in recession, they drink it when markets are calm, they drink it when markets are panicking. That kind of predictability is an investor's oxygen, but quality has a counterfeit version. A lot of businesses can make their return figures look spectacular by loading themselves with debt. That is why a high return number by itself is not enough to impress me. Debt can cosmetically improve the face while weakening the bones. Go back to that chicken stand. If I invest $1 million of my own capital and earn $150,000, that is one picture. But if I put in $1 million, borrow $4 million, build a much bigger operation, and report $500,000 in profits. Now people may clap at the higher percentage return on my own capital. They may call it brilliant. What they should call it is leverage fragility. When times are good, leverage flatters intelligence. When times are bad, it reveals character. Interest does not care whether your quarter was disappointing. The bill still arrives. A business drowning in obligations can look magnificent right before it learns to gasp. That is why I never ask only whether a company earns well. I ask how honestly it earns. I want to know whether the return is supported by real economics or inflated by borrowed money. The world is full of businesses that look impressive until funding gets tighter, rates rise, or demand stumbles. Then the mask comes off. The fourth mechanism is valuation discipline. Even a wonderful business can become a terrible investment if you pay a stupid price. This is where many investors betray themselves. They finally learn to identify quality. Then they become so proud of recognizing it that they forget price still matters. That is how you overpay for excellence and call it wisdom. If somebody tried to sell you a fine house for 10 times its sensible value, the fact that it is a fine house would not rescue the transaction. Stocks are no different. The business can be marvelous. The purchase can still be foolish. That is why I care about what the company earns relative to what the market is asking me to pay. People hear terms like price, to earnings ratio and price, to book ratio, and imagine a secret priesthood. They are just attempts to answer a plain question. What am I paying for what I am getting? If a business earns 10 per S-hair and sells at 100, that is one kind of proposition. If another sells at the same price while earning 5, that is a very different proposition. Same sticker. Different economics, of course. Industries differ. Banks are not software businesses. Utilities are not chip designers. A low multiple in one field may be perfectly normal, while a higher multiple in another may be justified by growth, durability, or capital. Light economics, the number alone is never the whole truth. The number is the invitation to investigate. That is where amateurs stop and real investors begin. Whenever you see something that looks absurdly cheap, you should not feel instant excitement. You should feel suspicion. Cheapness is often a confession. Maybe the profits were swollen by a one-time asset sale. Maybe the assets on the balance sheet are worth much less than the accounting suggests. Maybe the entire industry is quietly decaying. Maybe the market is not stupid. Maybe it knows the future is smaller than the past. This is where a great many investors get trapped. They think low valuation is a gift. Sometimes it is the market tagging the body before the funeral. I have no use for accounting mirages. That brings me to the fifth mechanism. I call it the survivability test. A business is not just a spreadsheet. It is a living economic organism. It needs earnings, yes, but it also needs real cash, manageable obligations, and a future that remains commercially relevant. Plenty of companies report profits on paper while their cash position tells a darker story. Sales are booked, receivables pile up, reported earnings look respectable. But cash does not actually arrive in the door fast enough. A business can appear healthy in the income statement and still be silently suffocating. That is why I care deeply about operating cash flow. If the core engine is not generating actual cash, the accounting story can flatter a reality that does not deserve trust. And I also ask a practical long-hold question. Does this business return cash to owners in a way that reflects real strength rather than desperation? A steady, durable dividend does not make a company great by itself. But when a company can pay owners, keep investing in the business, and gradually raise that payout over time without hollowing itself out, that tells me the machine is producing more than accounting theater. A high yield alone does not impress me. Sometimes a yield is high because the price collapsed for a very good reason. Sometimes management is paying out too much just to keep appearances clean. I do not want cosmetic generosity. I want durable earning power that can support intelligent capital allocation for years. And beyond cash, I ask whether the industry itself can still carry meaning 10 years from now. This is where investors who worship numbers get humbled. Kodak once looked excellent on many conventional metrics. The company was profitable. The brand was known. The figures could persuade you if you were lazy enough to stop there. But the future was moving under its feet. The world was changing from film to digital, and a strong report card could not save a weakening destiny. A business can be statistically attractive and strategically doomed. That distinction ruins people who think valuation alone is enough. I have often preferred businesses with slower glamour and higher predictability for exactly this reason. I do not need every company I own to be exciting. I need it to remain economically legible. I need to understand what it sells, why customers return, what protects its margins, and why that protection is likely to persist. This is why I tell investors to read the company's report card before they tell themselves a heroic story. I want to see the income statement and ask whether revenue, operating profit, and net income are rising for the right reasons. I want to see the balance sheet and ask whether the liabilities are a tool or a trap. I want to see the cash flow statement and ask whether the profits are arriving in cash or only in fiction. A business can flatter you in one statement and embarrass you in another. If you refuse to read the full report card, you are not investing. You are guessing with better vocabulary. That was one reason I stayed away from many technology names for a long time during the internet frenzy. People said my era was over. That never bothered me. My job was not to audition for relevance. My job was to avoid paying for what I did not understand. Later, when Apple's economics became clearer to me, when the device business, services, economics, ecosystem strength, and customer behavior looked more like an understandable machine, I was willing to move. Understanding comes before commitment, not after. That is the rule. Most people reverse it. They commit first, then spend months collecting arguments to defend the position. That is not analysis. That is self-hypnosis. Now let me tell you where this process becomes truly difficult. It is not in the formulas. It is not in the terminology. It is in the waiting. I call this the sixth mechanism, the patience premium. People talk as if doing something is the essence of investing. I have found that not doing something is often where the money is made. A good company can still be too expensive. A strong business can still require discipline from you in the form of delay. Waiting is not inactivity. Waiting is filtration. Waiting is what prevents a sound judgment about quality from being ruined by a reckless judgment about price. The market does not pay you for movement. It pays you for being right and for staying right long enough. Those are not the same skill. A surprising number of intelligent people ruin the first with the second. They find a fine business. Then they rush. They cannot bear empty hands. They cannot bear cash. They cannot bear the social humiliation of sitting out a popular move, so they buy before the terms justify it. Then they blame the company when the real mistake was impatience. I have never viewed cash as a moral failure. Cash is deferred action. Cash is stored optionality. Cash is the ability to act when others are emotionally disabled. If you spend every dollar the moment you see something decent, you are not disciplined, you are fragile. You have left yourself no room to exploit panic when it finally appears, and panic always appears. Which brings us to the seventh mechanism. I call it the split between market pain and business pain. This distinction saves fortunes. When a stock you own falls, you must answer one merciless question. Did the business change or did the mood change? Those are not remotely the same thing. If the business deteriorates, if the moat weakens, if management becomes foolish, if debt becomes dangerous, if the industry's future darkens, then I have no romance about holding. The reason for ownership has broken. The position should be reevaluated. Honestly, that is the first legitimate reason to sell. The second is more selective. If I find a materially better opportunity and I do not have the cash to act, I may reallocate. But I do not switch simply to feel busy. Constant replacement is often just impatience wearing a necktie. There is a third case investors love to talk about and rarely handle. Well, if a stock becomes absurdly overpriced relative to sober business value, a sale can be justified. But people use that excuse far too casually. A truly great business can look expensive for a very long time because greatness itself compounds. So I do not build a style around clever exits. I build around careful entries and durable reasons to stay. But if the market is collapsing broadly and a good company is merely being dragged by collective fear, that is a different event. That may not be a threat. That may be an offer. The pandemic panic in 2020 made this distinction visible again. Many strong businesses fell with everything else. The tape looked terrible. The headlines looked terrible. Human emotion looked terrible, but not every falling stock represented a falling enterprise. If the earning power survives and the franchise remains intact, the temporary collapse in price may improve the future return for the buyer who can still think. That is why the market transfers wealth from the emotionally urgent to the analytically prepared. The crowd sells because it cannot stand the feeling. The disciplined buyer acts because he cannot ignore the arithmetic. You may have heard one of my old lines about being fearful when others are greedy and greedy when others are fearful. People repeat it as if it were a slogan. It is not a slogan. It is a test. It asks whether your convictions come from business reality or from social temperature. If your convictions come from social temperature, you will fail exactly when the opportunity becomes largest. Now we arrive at the part most people hate. The eighth mechanism is the emotional tax impatience. Greed, fear, those three collect money from investors every year with astonishing consistency. Impatience makes you sell because nothing happened quickly enough. Greed makes you buy more because price validated your vanity. Fear makes you liquidate what you never understood deeply enough to hold. The market does not need to outsmart you. It only needs to expose which emotion is currently steering your hand. And emotion becomes fatal when it attaches itself to ignorance. That is why learning matters so much. I am often described as a man who reads all day. Good, that reputation is useful because it hints at the real source of conviction. Conviction is not personality. Conviction is earned familiarity. If you study a business carefully, if you know how it earns, where it is vulnerable, what its economics look like, and why you bought it, then price movement loses much of its power to terrorize you. Without that work, every decline feels like a revelation. With that work, many declines become a question rather than a command. That is the psychological edge people misunderstand. They think discipline means suppressing emotion through force. I do not think so. The best discipline often comes from clarity. When you know what you own and why you own it, you do not have to heroically invent calm every time the market shakes. You have a reference point, you have a decision framework, you have a protocol. And that protocol matters because eventually every investor faces the same mirror, not the mirror of intelligence, the mirror of behavior. Can you wait when a good company is not yet cheap enough? Can you hold cash without feeling useless? Can you buy when the headlines feel toxic? Can you separate business damage from market drama? Can you refuse leverage that flatters your fantasies but weakens your staying power? Can you admit a mistake when the business has truly changed instead of hiding behind loyalty to your own ego? Can you remain unmoved while other people celebrate shorter, louder gains in names you never wanted to own in the first place? That is the final test. People imagine the decisive moment in investing is the day they discover the great stock. Usually it is not. Usually the decisive moment is the day price stops cooperating and reveals whether you ever had a real standard. That is the threshold. On one side of it are people who live off borrowed narratives. They buy because the stock is rising. They buy because the media noticed. They buy because someone louder than them sounded certain. Then they panic because what they owned was never a business in their mind. It was only a moving line with a temporary story attached to it. On the other side are owners, not perfect people, not profits owners, people with a blueprint, people who ask whether the company makes money well, whether it carries dangerous debt, whether the price is sensible, whether the cash is real, whether the future of the industry remains intact, whether the stock can be held long enough for the economics to matter, and whether the fall in price is a warning or an invitation. That is a very different species of investor. That is the species that survives, and survival matters more than brilliance. You do not need to catch every fashion. You do not need to forecast every quarter. You do not need to impress anybody at dinner. You need to avoid fatal stupidity. You need to stop paying premium prices for borrowed certainty. You need to stop treating the market like a place to validate your identity. You need to stop letting price tell you what reality is. If you really want to invest the way I have tried to invest, then make this contract with your future self. I will not buy what I cannot explain. I will not call excitement insight. I will not confuse a rising price with a better business. I will not confuse a falling price with a broken business. I will not let leverage make me feel strong while making me structurally weak. I will not break my standards to avoid the boredom of waiting. I will not ask the market to make me feel intelligent. I will ask the business to prove it deserves my capital. That is the contract. Break it and the market will eventually send you an invoice. Keep it and time begins working for you instead of against you. That is the whole game. Not prediction, not noise. Not being first to repeat somebody else's enthusiasm. The game is to build a filter strong enough to reject almost everything, a standard high enough to endure discomfort, and a mind quiet enough to act only when the business, the price, and the future line up. Most people never do this. That is why most people spend their investing lives chasing motion and calling it strategy. I have never been interested in motion. I have been interested in compounding. Compounding does not begin with buying. It begins with refusal to overpay, refusal to pretend, refusal to own what you do not understand, refusal to let fear or applause think for you. If you can make that refusal part of your operating system, you will already be far ahead of the crowd that keeps learning the same expensive lesson in different market costumes. And if you cannot do that, then no indicator, no guru, no app, no newsletter, and no rising market will save you for very long. Because the biggest risk in your portfolio was never just the wrong stock. It was a mind without a protocol. That is what I would fix first. Everything else comes after that.